Hey, welcome back to the Hub Channel. My name is Brandon Burton, and we have another great show for you again today. We have Mike Wade that's going to be with us here in just a second. Mike is the founder of Michael Wade Trade Coaching, and he's going to be coming back with his new high profitability, short-term live trading here. And as you can see, we're going to be trading the market here coming up, and the market is breaking down just a little bit today, so we're going to want to watch that and see how he trades that. So up on the show, we have our market review where we're going to go through that, earnings season, the portfolio performance, and a current live trade, just kind of like I talked about here in a second. Now, Mike, come on in here. Mike, last week you gave us a great trade. Obviously, we're going to talk about that trade and kind of what that did for us. But what are you seeing right now in the market? What's happening? I know we're just before open when we're recording this, and so everybody's going to know what's going on. But what is happening in the market? Why is it breaking down? And what's that going to do for our trade right now?
Yeah, the markets yesterday. And good morning, Brandon. Good to see you again, buddy. Hope you're doing well. It's always fun to be on this call.
Doing great. Yes.
Awesome, man. Well, the markets. I would be a little less calm than you. I'm actually a bit excited about how aggressively the markets are coming down. And yesterday, why don't we look at a chart, because the chart will speak 1,000 words. So I'm going to pop up this chart of the S&P 500. This is the SPYs. It's an ETF, which means it's an exchange traded fund, but it's a stock that broke down below this blue line here. That's the 200-day moving average. It did it here on this day here. Let me zoom in a little bit so we can see this a little more clearly. And what I'm seeing here is a decided downtrend right here on this day. The SPYs closed below the 200-day moving average. In the first time in months, it closed below the 200-day average, and it did so on above average volume. High volume. 2 days later, it attempts to bounce to get back up above the 200-day average, and then yesterday, boom, closes with great conviction. Volume, the way I think of volume is conviction, really institutional conviction, because institutions control, let's say, 80% of the market, certainly of the S&P 500. That's considered an institutional playground. So institutional investors, big money traders, hedge funds, managed funds, they control the market. And yesterday, they dropped the SPYs hard below the 200-day average and did so on great conviction. That pattern is present across the board. Even the NASDAQ, the Qs, triple Qs, this is the NASDAQ 100. And what's really interesting about this chart, and I mentioned this last week as well, there's this pattern that was in place, has been in place for a little while now, and it's called a head and shoulders pattern. And so I've drawn some bubbles here, and you can see there's a shoulder, there's a big head, kind of like me. There's another shoulder. And then what we've been waiting for months now is the NASDAQ 100 tech stocks, tech laden index has come down finally. And when I say finally, you might get the feeling, Brandon, that I like markets breaking down. And I do, so much so that I get a little saliva in my mouth, because it's very high probability stuff. When you see markets breaking down like this, these are indices that have hundreds of stocks in them. And so the index, the basket of those stocks coming down hard below the 200-day, below the neckline, this green line here, and did so yesterday on above average volume. I think we're heading to the 340 level, the 200-day moving average. And a couple more here. Let's look at the diamonds. This is the Dow Jones ETF, and it's also in a head and shoulders pattern, not really marked. If I put my cursor right there, that's a head and shoulders pattern, shoulder, head, shoulder, and we're well below the 200-day average now. It looks like we're going to break 330 today, and I would say 325 is in the cards. The Russell 2000, same thing. This one's got a beautiful head and shoulders pattern and a death cross where the 50-day, the red line, crosses below the blue line, which is the 200-day moving average. And look, yesterday, I mean, this is like skies falling, Chicken Little skies falling on the small caps. These are the 2,000 smallest companies in the US market. So stock traders, when they see this, Brandon, not super excited, of course, but option traders, the way we're trading snipers, this is like, I got to be responsible with my language a little bit, is almost like shooting fish in a barrel. So I'm excited,
Oh,
and I mean, I'm sorry, I'm
yeah,
excited.
yeah.
I always get excited when I trade because it's a game. I love this game. It's like I get to do this every morning when I wake up. Yeah, you do. The other thing, Brandon, that's exacerbating these moves is earnings, and so we are in the heart of earnings season at the moment. We have a little graphic there that will show you the distribution of earnings announcements over the next, 3 months, 4 weeks. So that is those are catalysts for us. And when you consider that interest rates have been lifted for the last year and a half, consumer debt is at $1 trillion plus. People are running out of money. Inflation still hasn't cooled off enough. Consumers are starting to spend less. So that's having an impact. And I'm expecting a lot of volatility over the next month. And then we have just a look at the radar for today. And you can see here that we have some big names announcing today. Amazon is one of them. Yesterday we had Meta. So I keep an eye on these. And, look at some of these big names here for today. Amazon, Enphase, which makes batteries, like car batteries, Intel, Ford, my favorite Mexican restaurants, Chipotle, Mexican Grill, even Hershey's chocolate came out this morning with earnings. They're down today. UPS, Royal Caribbean, Southwest. I mean, there's a lot. We can go on and on. And then on the left there, you'll see that there's one called Align. Last week we traded Netflix, and maybe we can look at that one here in a sec, Brandon. But, last week we traded Netflix, which I'm a consumer of. And then Invisalign or Align Technology is another customer. I was a customer of theirs as well. And it just so turns out that there's a really good opportunity on Align that we'll take a look at here towards the end of the show.
Well, I've been watching all this, Mike, and I've been seeing the trade, the tech earnings, the announcements this week. We watched Google earlier in the week do really well on earnings, but then it broke down as well. So it seems like that's going to be the trend. And I know that you're super excited about this market. And a lot of people, a lot of the option traders that I do know love trading a down market, love trading these bearish patterns because it's so much easier to predict. And your high profitability trades are meant for this game. So that's what's really good about this market right now. So what did happen with Netflix? How did that play out last week? I know we covered that in last week's show. What did you end up doing with that trade?
Yeah, let's take a look at it here. So this is a chart of Netflix. And the last time we got together, Brandon, when we did our first show, Netflix had gapped up. Let me zoom in on the chart a little bit so you can all see it. So Netflix was down here. This is the 200-day average. That's the 50. And this is ideal because what happened was Netflix blew out their earnings. They were expecting 6 million new subscribers. They got 9 million, which is good for revenues, right? And they lifted their subscription price by a few bucks. And Netflix gapped up. It's closed here and then gapped up well above this 200-day average. And then the 50-day average was the stock closed above it. Now, support and resistance is really key to this particular strategy that we do. So when you see a gap like that, a bullish gap based on exceptionally good news, the chance of that stock coming back down is minimal. Said a more positive way, the probability of profit just counting on the stock not dropping back down is super high. And so this system is all about stacking up probabilities from a technical perspective, from a news perspective. And then the prognosis that we came up with last week was, well, based on what Netflix did and their earnings, all this great news and support at the 50 and support at 400. These, if you look at my cursor, you can see here support levels and support, let's call it 390 or so, and the 200-day average and 375. We drew a line in the sand right at 375. And we said, you know what? I want to make some money over the next couple of weeks, provided Netflix doesn't drop back below 200-day average, the 200-day average. So for that to happen, one, the news is so good that it's not likely to happen because of the great news. It's also technically not as likely to happen because of support at 400, the 50, 395, the 200-day average, and 375 itself. So this is a game of probability. Well, we'll take less money in exchange for being right. And my record since I started this system is about 90% wins with an average gain of about 10%. So that's the general game, Brandon, and what we did on it. And I'm going to use a tool called a risk graph. This is a tool system I use to track my trades. And, it might be a little complicated, but let me just take you through it. So what we did was we sold a 375 put, and then we bought an underlying put. Okay, so this is what we call a credit spread. So if you look at the pricing here, we sold the 375 puts for $1.85, and then we spent $1.46 of it to protect ourselves to the downside, netting 39 cents. This was filled live last week, Brandon. We got 39 cents in a live account, and then the risk of this trade is 211. And so what that gave us was the opportunity to make 18.48% over the next 8 days. This is an 8-day trade with a high probability of making at least 18.48%. And then we have this thing called a risk graph. A picture paints 1,000 words, and a risk graph does that for our trade. And what a risk graph does is it delineates stock price on the vertical axis to whether you're making money or not on the bottom axis. So this line here is what we call our break even. So as long as the stock is on the right side of this vertical line, there's profit. So there's our max profit in the trade. All right, that's max profit. That max profit is $78. We did 2 of these. 2 times 39 is $78 is max profit on this trade. Max risk, though, is $422. Okay, so that's the situation. We're going to take less money with a super high probability of making it. The only way we lose is if Netflix breaks back down in the face of all of this great news, all of this amazing technical technical pattern. The stock's going to have to break down below those support levels, below 375 itself, and then we start potentially making money. So this was the day we placed the trade. We got in the morning, and then by the end of the day, we already had 13.7% profit. Now, the most important part of this system is risk management. The most important part of trading is risk management. So what we do here is our rules are simple. If the stock closes back below our 375 line in the sand, then we exit. And I can estimate roughly what I would lose if that happened. So let's say Netflix drifted back down and then closes below the short strike, the short put, 375, our line in the sand, then we exit the trade and we control our loss. We don't take $425 of loss. We'll just take maybe $100, $150 of loss. So that's the most important rule. And the second is the minute we can buy this spread back, for 10% of the original credit, then we exit. And we'll use good till cancel orders to take our profits. So at the end of this particular day, the spread was worth about 25 cents. So we didn't hit our stop, almost hit it here. As the stock rose up here, we almost hit it there, but not quite. And then let me walk you through this trade a bit. The next day, the stock sort of dropped a little bit. We were down, we lost a bit of our profit, at least for one day. And then, so this is a waiting game. We only have to wait 8 days. And then here's the day. Let's see, here. This is the day we got out. So we got in here. Netflix kind of dropped a little bit, little consolidation, started making a run. And then on the 24th, 5 days later, we took this trade off for 2 cents in this case. That was a GTC order. And we netted about 17% return on this trade from a max of 18.48%. So Brandon, short term, by short term, we mean an average hold time of about 8 days. That's how short term this thing is. And we put these trades on and we do so with great probability of profit.
Which when I'm looking at this and when I'm seeing these trades kind of play out, it is really short term. So somebody comes in here and they say, oh, 13% profit. That's not that big of a profit, but when you annualize that, and I'm not going to annualize it because sometimes that gets crazy numbered, like when you annualize that profit, it's absurdly good. So we're doing these trades in 1 day, 2 days, 8 days, where you put that Netflix trade on, you absolutely crushed it. And the chart looked so good, but your risk management on these trades is astounding. So I guess I have one question for you. Where can people go to sign up to get more of this information and see these types of things, Mike?
Yeah, thanks for asking. And you're right. I'm going to say a quick word about the amount. The average profits on these is generally in the 10% range, but every week you could take that money and churn it at least 3 times a month. And you take the same amount of money, and if you're able to do a 10% on average 3 times a month because of the 8-day hold time, that's 20+% a month, 24%. But 20% a month over 12 months. So this is like, I mentioned this last week, Brandon, and the movie Moneyball, I've watched it 5 times. I love that movie. And they hired this guy to come in and get the floundering Oakland A's into a championship with no money. They had no budget to buy the best players. And so all they did was create a strategy to just get on base. So to put players on the team that had a history of getting on base. That's analogous for us here because we just want to get on base. That's all we want, just get on base. So, Brandon, what was your question?
No, that's high probability. Well, I guess I got even more questions. I got 2 questions. That was the opening bell. We want to see a trade live right now. Let's go ahead and do that trade. I want to see what you got going on since the market just opened. But then you got to tell people where to go find out about your stuff, Mike. Obviously, we want to hear more. And people want to know more about this high probability fast trading stuff. So let's get into that live trade and do that.
All right, good. Well, we have a little graphic on Invisalign, and you can find. I'm looking for gapping stocks. So you know what Invisalign does, right? They make the
gap in the teeth. So that's your analogy there, right? The gap.
Yeah, exactly.
I got you. I got it.
So now. And it was expensive, so now I'm going to go get my money back by selling a spread on Invisalign. And Invisalign, as you see in the graphic here, that's some pretty bad news. Invisalign, Align is ALGN is the symbol, dropped 23% pre-market, and it's already down. We're going to look at the chart here in a minute. And Align saw 2.14 in earnings per share, while analysts had expected 2.26%, and the revenue is a really big miss as well. 960 was reported, 995 was expected, and the company also gave weak guidance. All right, so probability, technically speaking, we already have high probability. because the stock is trading here now. Last night was up around 250. Now it's beneath 200. It's trading at 197, 196. It's dropping a little bit as I speak. Now, ideally, we come in and we swoop in and we grab the credit right at the open, but we're still in good shape. So the point is that the stock, when you see a company, this is the best, worst news. When a company misses earnings like they just did, and they lower what's expected for the next earnings announcement, it's very unlikely that that stock will go up. And so what I'm looking at now is, well, where is my line in the sand? Where might I place my line in the sand? And by that I mean, I just want to make money below a certain point. Maybe it's 200, maybe it's 225. Now, yeah, I'd like to put my line in the sand at 250. Again, the line in the sand is a point at which I'll sell a credit spread and we'll make money anywhere below that line in this particular case. Now, the thing about doing that is the higher you make the line, the less credit you'll get. So we have to sort of figure out how close to the heat do we want to get. 225, 200. 200 would be the closest that I would get because the stock just today was right at 200. It could, over the next course of an hour, start to drift back up. That's possible. So I've just got to figure out what we can get. So I like maybe 220 on this, or 210. And so now what I have to figure out is, well, how much money, how much credit can I get if I were to sell at 210 or even 200? So what I'm going to do now, Brandon, is go into a simulated broker platform, and I'm going to use this one called Thinkorswim. And it's a live broker analysis. Well, it's a broker, so I can trade options. I've gone into the option chain, and I'm going to look at two places here. So again, I'm looking at seeing what can I get. So here's an 8-day trade here, Brandon. We could sell at 220, and there's 72 cents of credit there. If I go to 200, there's the credit. We're selling the 220 and buying the higher strike. If I go to 200, which is a little close, there's $1.40 in credit. So as I go from 200 to 205, lifting up the line in the sand to 205 in this case, there's $1 credit there. That's interesting. And then higher still at 210. And we've just opened, so the slippage is all over the place. And then if I go to 215, I'm seeing currently $1 of credit there. And this is for an 8-day trade. So let me show you something here, guys and girls. I want to give you an ability to calculate your potential return on investment, your max return on investment. And so here's a little calculation. We're going to be launching a guide next week, Brandon, that will have all of this in it. And when I give my our website address here later, you'll also next week be given the opportunity to grab this free guide where I have all of this data that I'm covering right now. So the way you figure out max risk in a credit spread is you take the distance between the strikes. So for example, back to this one. If I'm liking this credit, that's a good credit. So we're selling the 215 call and then buying the next higher strike call at 220. So the distance between those strikes is 5. All right, let's go back here and plug in the spread width. All right, now the amount of credit, back to this pricing here, the amount of credit that's currently available, I got to hurry because this credit will evaporate we got about 10 minutes. I want to grab this credit as quickly as possible. So I'm doing some teaching here so that you can understand what I'm about to do. So 127 is the current credit. So 127. And then the max risk of the credit spread is the width of the spread minus the credit. So if you do the math here, our max risk is $3.73. All right, so we're going to potentially make $1.27, and we'll do that. To do that, we'll risk $3.73. And then the ROI, or the maximum return on investment, is calculated by taking the credit and dividing it by the max risk, yielding a 34% probability potential return on investment. Now, and it's 8 days, by the way. So that's a big one, Brandon. And now see, the credit's already evaporated. So I got to move faster on these things in order to grab the credits at the open. That doesn't mean we can't go after this trade. We just might need to change our strike prices. All right, now let me go back to the chart here and see what the stock's doing. You can see here that there's what's called a hammer pattern forming, and there's resistance here at 200. There's going to be support and resistance at every round number, pretty much. In this case, every 5-10 points, you're going to see support and resistance. So if I go back further in time here, so I'm looking here at support and resistance. Here's 200, and you can see here at 200, indeed acted as support there, resistance, support, resistance, and support. So that's a mega strong level, Brandon, and I would be very surprised to see the stock move back up above 200 anytime soon, but it might, especially given that there's a bit of a hammer there. So here's what I'm going to do. Let's see what we can get at 210. That's the line in the sand I want to use. So the trade would be all about, I'm counting on the bad news, keeping the stock from rising. Go ahead and drop all the way down to zero if you like. That's fine. Go sideways. We'll make some money. And I'm going to give you 10 points to rise. And as long as you don't rise any more than 10 points, then we'll make money if we sell our credit spread at 210. So that's the line I'm going to use here. And then I find the strikes here, and there's 82 cents. I'm going to see if I can get 80 on this. I'm back over here. Let me plug in my data here. So that's 19% in 8 days. I'll take that. My rule of thumb, Brandon, is generally give yourself at least 1 percentage point of potential credit for every day in the trade. So that's what I think I'm going to do here. I know I'm bouncing around a little bit. So let's go after the 210, 215. And to make it easier for all of you to understand, what I'm going to do now is create a risk graph in a tool set I use called Tom's Tools. And I'm going to build this trade so you can see the picture. And I'm not going to teach you the tools here, but I just want you to see the risk graph. Now, if I was able to get back to sink or swim, let's call that 80 cents of credit. It's bouncing around. If I got 80 cents of credit, then my risk graph would look remarkably like this. I'm just going to dummy up the pricing and let you see the risk graph. So here's the risk graph. The stock is, this software is 20 minutes delayed. But currently, the stock is way down here. But the point is, you can see that our entry credit has been calculated, our max risk calculated, and then this is showing a probability of profit of 19%. Okay, so that's the available profit return that we could make on this trade. So I'm going to go get this. You know, there's a lot to teach here on the credit spreads, Brandon, and I have the guide that we'll release next week. So there's a lot of moving parts. And at first can be complicated. It was for me the first time I went after this stuff. But put in your sights that if you're able to replicate what we've done in this system with 90% win rates and averaging around 10% every 8 days or so, would that make a difference in your trading account? If the answer is yes, then you'll learn this. And the guide that we'll send out, we'll give you an opportunity to grab next week. It's not even a guide, it's a book. It's going to be, I think it's about 40 pages that will walk you through all these steps. One of the steps is max risk. All right, so this max risk, in the spreadsheet, I showed you how to calculate. So you can calculate your max risk. You can get to the math here. But let's say that we're not going to risk any more than 2 to 3% of your entire portfolio value. So if you had $10,000 in your account, then you should only risk maybe 200 to 300 of that money. That's rule number one in trading, everybody. Your job is not making money. Your job is risk management. That's my job, is risk management. So rule number one is don't back up the truck and put 5,000 of your 10,000 into any given trade, because if you're wrong on that one trade, you could eliminate half your account. Don't do that. So 2 to 3% max. So if I had a $25,000 account, I could certainly take this trade on. So I'm going to do one contract and keep my risk contained to $420. All right. So now I know how many I'm going to do. One, November 10. Here's the trade then. You want to sell one, ALGN is the symbol, November 10, 210 call, and then buy the 215 calls above. That will net you a net credit. How much is it worth now? It's worth $1. Awesome. So I'm just looking at a live simulated platform in Thinkorswim, not recommending Thinkorswim, and it's showing us $1.07 credit. Now that credit has risen since I've been talking. So now I'm going to go check the stock and make sure the stock hasn't risen too much. I want it below 200. I want it below 200. So let's go back to the hub chart here. And yeah, 200 is still holding. This is live data right here on the hub chart. 200 is holding at the moment. And I'm going to put my line in the sand at 210. I want it. Yes, please. Showing $1.30 credit at the moment. Let's go ahead and grab it. I'm going to hit confirm and send. Oops, it just changed to 95. Let's get $1. Let's go for $1 on this one. Brandon, when a stock drops 24%, it's like a feeding frenzy. Option traders are going nuts for the options, and the pricing is all over the map. Indeed, it's just dropped to 60. So what's that, bud?
You can see that pricing going all. Yeah, you can see that pricing going all over the place, and this always happens when this on earnings, expiration, everything like this always happens. The pricing's all over the board. So good luck with that, Phil.
Yeah, thank you. Let's put it in there and see what we can get. I'll put it for $1. And then I hit confirm and send. Not really here to teach you Thinkorswim. Just want to show you the steps that we take. And we'll be doing this every week. So over time, and with the guide that will be ready next week, as I keep saying, you'll be able to replicate these steps. And so this show is a live trading show. We got $120, $1.20, Brandon. Woo! Yeah, I trading with emotion is not generally a good idea, but I love this. This to me is like a really delicious game. We just got $1.20. So under filled orders here, we sold one, a line, 210 call for $3.50. We bought the 215 call above for $2.30. So what I'm going to do now is take that data and go back to the risk graph. So you can see, we can now see automatically generated our potential return on investment on this trade. So let's plug in 350 and 230 back to the risk graph. We sold for 350. We bought for 230. And this is the trade we have now. And I'm going to save this. I'm keeping track of all our trades, Brandon. And I'm going to save this one in a folder, and we can talk about how this did next week when we get back together. All right, so that's the situation. Now, what do we do with it now that we're in? You know, it's easy to start a relationship. It's hard to get out of them. It's easy to get into a trade, an options trade. Sometimes, well, it is hard to get out of them unless you have rules. And so fear and greed come in, and hope comes in. So much hope comes in that people get addicted to hopium. We're going to have simple, discrete, black and white, exact conditions at which to exit. The first one is, if we sold this spread for $1.20, which we just did, then I'm going to put an order in that says, I'm going to buy this back for 10% of what I sold it for. So this is called a profit stop. So the instant I could buy this spread back for 12 cents, I'm out. So that would net you 90% then of your max profit. So let's say it this way. If you sold something for $1.20 and you bought it back for 12 cents, which is 10% of $1.20, then you've netted the difference. What's that? $1.08. And we're going to grab it. So the instant that's there, we're going to take our risk off the table, free up the max risk in the trade. And then I can go do another one. So it shortens the hold time and it automates profit taking. So the next step then is, once you're filled, then you put an order in to buy the spread back for, in this case, 12 cents. I mean, I don't know if everybody knows this. When you buy or sell an option trade, whether it's a spread or just an individual option, the option price is then multiplied by 100 to get the net impact on the dollars above. So we sold this spread for $1.20 and then multiply that by 100, and that's where you get your total dollars in credit. All right, next step then is, let's put an order in to buy this back for 12 cents. So how do you do that? Well, if you look here, we sold the Align November 10, 210 call, and we bought the 215 call. So what we'll do to get out of it is to sell to close the 210 call. I'm sorry, did I say sell? I meant buy. We sold to open, we'll buy to close one Align November 10, 210 call, and then we'll sell to close the 215 call. Flip the battery in backwards, swap the buys and the sells. And so to do that in a think or swim environment, what you can do is you go to your filled orders here. There's our $1.20 in credit. And then I can right click, create opposite order. And we'll then notice it's exactly what I said. We're going to buy back the 210 call, and then we're going to sell the 215 call. And I want to do that for 12 cents. And it's not worth 12 now. We have to wait. And then I'll make that a good till canceled order, a GTC, good till cancel order, confirm and send, and then I go back to the open orders here, and it's like a crab trap. It's sitting out there, and already, Brandon, we could buy the spread back right now for 80 cents, netting some profit. And what we're going to do here is follow our rules, and we're going to wait. We're going to wait until the market makers will let us buy it back for 12 cents. So it's just sitting out there like a trap, Brandon, just waiting for that profit target to hit. So now you don't have to touch the keyboard on profit taking. That'll take you out of the trade before expiration, unless the stock rises. So here's the line in the sand is 210. So we're back to the risk graph here. So the 210 call is our line in the sand. Let me take you back to the hub chart here so you can see it on a chart. Now I don't have it exactly shown at 210, but the exit rule is simple. If the stock closes greater than 210, buy it back. Buy it back, close it down, and take a loss. And then what's going to happen, I guarantee it, is you're going to say to yourself, well, maybe the stock will go back down and maybe I should hold on and hope. Don't do it. 1 out of 10 in this system generally lose. So the chances of it happening are not high. And even if it does, there's 9 more coming afterwards, winners coming afterwards, if the probability holds. No guarantee for the future. We're predicting the future here. But I would say, Brandon, with this system, we're predicting the future with great probability of profit. That was a lot, I know.
Yeah. I mean, you walked through that whole trade. You walked through the open and the close of that trade, which is more than I think you should have done. So that was nice of you. But the education was great, Mike. Let's go ahead and let's touch base again next week to see how this trade plays out. If you guys are watching this show, by all means, be sure to come back here next week to watch to see how this trade plays out. Mike, as always, thank you so much for dropping by the channel today. You did really well. I'm really excited to see what happens here. Do you have any closing words for anybody else? Do you want to say goodbye?
Well, yeah, you asked me a question earlier, Brandon, and I didn't answer it. And how do you get in touch with me and my team?
That's it.
I've got a company called Michael Wade Trade Coaching. I launched it in July of last year, 2013, July 13th, 2022. I've been teaching for 25 years. Been doing this a quarter century. And I've created an environment within which I believe people thrive, a community, lots of support, love even. And if you'd like to know more about that community, you can go to mwtradecoach.com, www.mwtradecoach.com, and you can learn more about us and be very happy to support any of you if you so desire. So Brandon, it's been a pleasure. I love this system. I like being in a room with you, and thank you for giving us this space.
Perfect. Yes. By all means, go to that website that Mike just talked about right now if you get a chance. He knows what he's talking about, and this trade strategy is so profitable, but I love the way that he explained it today, and we can't wait to hear more from you. Guys, if you guys are watching, be sure to like, subscribe to the channel if you can, and we will see you next week here at the Hub channel.
Bye, everybody.